More great news for 2015, and actually this is for 2014 wrap-up, but mortgage insurance tax deduction is a deductible and back for loans closed in 2014. As a homeowner, you are well aware of the many home-related tax breaks, but in 2014, if you closed on a home or a refinance, it just got better. Originated in 2007 and extended on December 19th, 2014, legislation is passed once again, allowing for the tax deduction of mortgage insurance premiums for qualified borrowers. This tax deduction was created as part of the Tax Relief and Health Care Act of 2006 and again originally applied to mortgage insurance policies insured in 2007. Unless Congress renews this deduction, it will not apply for loans originated in 2015. The deduction is effective on purchases and refinance transactions, again, closed December 31st, 2014, or before. Now, the private mortgage insurance deduction can be taken for policies issued by private insurers as well as insurance provided by Federal Housing Administration, the Department of Veterans Affairs, and the Department of Agriculture Rural Housing Service. So basically, your conventional FHA, VA, and USDA financing is a potential qualification depending on you and whether you qualify as an individual, which we'll talk about. It's counted as an interest. So many homeowners itemize their deductions because their mortgage interest and property tax payments exceed the standard deduction amount they could claim. It's in the interest you paid section on your Schedule A that you'll find on the private mortgage insurance deduction. It's claimed on line 13. And the mortgage insurance deduction applies to refinances on the original loan amount, but not any extra cash that you might have taken out in the loan on that refinance. It may also qualify in a second mortgage if it was a purchase money second. If you did do a second mortgage and the second mortgage was utilized for improvements on the home, that's not counted. And we're talking about the interest deduction, because if you have a second mortgage, you're actually not going to have PMI for that. If you purchased a second home, it would qualify as well. You can purchase a second home with less than 20% down, which would mean you'd have more private mortgage insurance to pay on that. Now, there are income phase outs. There are no statutory limit on the amount of PMI premiums that you can deduct, but the amount might be reduced based on your income. So the deduction begins being phased out when your homeowner adjusted gross income, or AGI, is more than $100,000. This income limit applies to single, head of household, or married filing jointly taxpayers. So the phase out begins at $50,000 AGI for married persons filing separate returns. So the PMI deduction is reduced by 10% for every 1,000. A file's income is over the AGI limit. So the deduction disappears completely for most homeowners whose AGI is $109,000 or $4,500 for married filing separate taxpayers. The Schedule A instructions include a workout sheet, and as most of the tax preparation softwares will as well. But you always want to double check with a licensed CPA. And as always, if you need a introduction to one, this is the Money Hour, and I bring into studio the best of the best in every arena regarding your finances. So call into the show and I can get you connected and introduced to a certified licensed CPA. Now, for any of my listeners, my renters out there, a shout out to all of my renters. My advice is to run numbers. If you're renting, to compare with homeownership. There is a difference between rent and mortgage payment, which we have talked about before. Mortgage interest deduction is the first. So when you pay a mortgage, the interest that you pay on a loan is deductible up to a maximum threshold or maximum income limit. So for most people qualifying for 100% of the deduction on their mortgage interest, if you had a 4% interest rate on a $400,000 mortgage, your deduction would total over $16,000 for the year. If you were in a 28% tax bracket, this deduction would save you over $4,400 a year. There are no deductions if you're paying rent. Now, property taxes are deductible as well. Property taxes fully deductible for homeowners, any range from 1 to 1.5% of the value of a home based on our local market here. So if you're paying a rent of $1,500, just an easy way to calculate an estimated deduction or benefit of tax benefit would just Take that and add your tax bracket. So if you're in a 28% tax bracket, we're going to add that to $1,500, and that is equal to a mortgage payment of $1,950 a month. Again, these are just hypothetical examples, but talking with a licensed CPA, you can find it exactly where you're going to fall. To wrap it up to my renters and encouraging right now in this opportunity for real estate where interest rates are at, the tax benefit that you have, when you sell your home, you also have another benefit up to $250,000 if you are a single or $500,000 if you're married, and profits is exempt from taxation. What other asset class do we get to see this type of benefit? Any amount over those thresholds is taxed at capital gain rates. Historical capital gain rates have been substantially less than tax rates on the original income. When you leave an apartment, no tax will be due, but you're not going to have any profit anyways. So last is 30-year fixed rate mortgage. That is a 30-year fixed rate. You can get a fixed rate mortgage. What does that mean? It means it's fixed for the life of the loan. So you know exactly where your mortgage payment's going to be outside of taxes and insurance adjusting on an annual basis possibly. But rent, you have no idea where your rent payment's going to be. Take a look at how much your rent has gone up in the last couple years or since 2008 when the crisis happened. It's been unbelievable what's happening. And then last is on a mortgage, you do have eventually at some point in time, you're going to be mortgage free. If you have a 30-year fix, that loan's going to be paid off in 30 years. Rent, there's no payment site and end. Or no end in your payment site. However you want to look at that, it's the same. So really good opportunity, again, for renters to take a look at the numbers, run the numbers and see how it is for you to take advantage of home ownership. Coming up next in the Money Hour, making small changes on your credit report and how you use your available credit lines can make a big difference in your credit score and everything regarding your finances. Scott Schaff with SW Group Credit Repair right here in 1150 AM KKNW after this short break.